I've spent decades watching financial markets, long enough to recognize how the same patterns keep returning under new names. I've seen gold climb to levels that once seemed completely unrealistic. I've watched oil soar so high that investors felt unstoppable, only to collapse just as quickly and strip away that confidence. I've seen technology stocks transform ordinary people into paper millionaires, then erase those gains once the narrative changed. And right now, I'm seeing something that feels strikingly familiar. This time it's silver. Silver is trading close to $100 an ounce today. Some quotes show $100.10, others $100.30. That small difference is irrelevant. What matters is the level itself. Because when a price reaches a number like this, it begins to shape how people think. It triggers a psychological switch. That's why I keep hearing the same questions again and again. Should I sell now and lock in profits? Should I hold and wait for $130 or $150? Or should I buy more because this rally doesn't seem over yet? Let's slow this down. In March of 2020, silver was trading around $19 an ounce. Pause and think about that. If you bought at that level and held until now, you've watched silver rise from $19 to nearly $100. That's more than a fourfold gain. This is usually the moment when clear thinking starts to fade. And that's why the next decision is more important than the previous one. Moves like this don't just grow portfolios. They stir powerful emotions. They make people feel clever. They convince them they've figured it all out. They believe they've cracked the code. And that's typically when problems begin. Before making any move, you need to understand one central idea. If you truly grasp this, it will shield you from more financial mistakes than almost anything else I know. And this lesson isn't only about silver. It applies to every investment decision you'll ever face. Most people don't actually invest. They speculate. They buy because prices are going up. They sell because others are panicking. They react to headlines, fear, hope, and secondhand opinions. That isn't investing. That's gambling. And over time, gambling is how people lose money. Let's look at history. In 2011, silver peaked near $49 an ounce. At the time, many were convinced it was headed to $100, $200, or even higher. Confidence was everywhere. Then reality stepped in. By 2015, silver was trading near $14. That's a drop of more than 70%. And this is where history quietly delivers its most expensive lesson. Those who chased the excitement suffered badly. The ones who came out ahead were those who sold when emotions were running hottest. They didn't fall in love with the story. They treated silver as a position, not a belief. So the question today is straightforward. Is this another 2011 moment? Now set the price aside for a moment, because understanding why something moves is far more important than guessing where it goes next. I don't know the answer, and neither do you. What I do know is that fundamentals matter, and psychology matters even more. So let's break down what's actually driving silver right now. Listen closely, because this is the point where disciplined investors and emotional ones part ways. Same price, same chart, completely different outcomes. First, the macro environment is pushing hard assets higher. Silver crossed $100 as gold and platinum reached record highs. Why? Because markets are anticipating easier monetary conditions, a weaker dollar, and ongoing uncertainty. When confidence in paper assets fades, money often flows into things that can't be created at will. Second, supply and demand are misaligned. Global silver production is around 830 million ounces, while demand is closer to 1.2 billion ounces. That creates a shortfall of roughly 370 million ounces. When demand repeatedly outpaces supply, prices eventually respond. You can argue about timing, but you can't ignore the math forever. Third, industrial demand isn't a temporary trend. It's structural. Solar panels require silver. Electric vehicles use far more silver than traditional cars. Modern electronics, medical equipment, and 5G infrastructure all rely on it. This isn't speculation, it's real, physical consumption. Fourth, investment demand adds another layer of pressure. When people worry about inflation, currency stability, or geopolitical risk, they move toward hard assets. And silver is a relatively small market. It doesn't take much buying pressure to send prices moving quickly. Analysts have noted that expectations of future rate cuts, a weaker dollar, and rising geopolitical tensions are all increasing volatility. At the same time, they caution that profit-taking can appear suddenly and without warning. Both of these things can be true at once. A strong upward trend can exist, and sharp pullbacks can still happen out of nowhere. Now here's something many people miss. Silver prices in Shanghai are reaching record highs as Chinese investors aggressively move into precious metals. When demand for metals increases in China, global prices often follow. Why? Because it signals weakening confidence in traditional assets. Real estate markets are struggling. Equity markets are unstable. Currency pressures change how people behave. When local prices rise above global benchmarks, arbitrage opportunities open the door to real physical flows. This isn't online speculation, it's actual metal changing hands. This rarely makes headlines, but it's often what quietly shifts markets behind the scenes. Still, none of this guarantees that silver will move straight to $150. Markets can remain irrational far longer than most people expect. And if you're feeling uncomfortable right now, that's completely normal. This is the stage where emotions begin to interfere with sound judgment. Silver is a commodity, it's not a business. Coca-Cola generates cash. Apple creates new products and innovation. Businesses grow, reinvest, and compound over time. Coca-Cola has increased its dividend for more than 60 years. That's how wealth truly compounds. If you buy 1 ounce of silver today and hold it for 30 years, you'll still own 1 ounce of silver. Its value depends entirely on what someone else is willing to pay in the future. That doesn't mean silver can't rise further. It means it must be treated differently. So here's the framework I use. First, ask yourself why you bought it. If you purchased silver at $25, $30, or $40 because you believed in inflation protection and long-term demand, that thesis hasn't broken. If anything, the fundamentals may be even stronger. But if you bought at $70 or $75 because you expected it to hit $100 next month, that wasn't investing. That was a bet. And bets require exit plans. Second, consider the size of the position. If silver makes up 5% of your portfolio, volatility won't destroy your future. But if it's 50% of everything you own, you're taking massive risk. In the late 1990s, people piled into technology stocks. Many had nearly all their wealth concentrated in one sector. When the Nasdaq fell almost 80% between 2000 and 2002, diversified investors survived. Concentrated ones didn't. Third, ask whether you'll need the money soon. If you need cash within the next year or two for education, housing, or paying down debt, volatile assets are the wrong place for it. Commodities move quickly and without warning. They don't care about your timeline. This is where even investors who are right can still lose money. Now let's talk about the psychology of selling. When silver was cheap, you barely paid attention to it. At $25 or $30, it wasn't exciting. Nobody bragged about owning silver at $19 in 2020. Now that it's near $100, you're watching it constantly. You're imagining tops and bottoms. That's human nature. Some of my best investments worked because I did nothing at all. When I bought Coca-Cola decades ago, the wealth didn't come from trading. It came from patience and compounding. Silver doesn't compound, so discipline becomes even more important. Let's move from theory to something practical you can use. Here's a straightforward approach. If you bought silver around $30 or $40 and it's now near $100, consider selling half. Lock in gains. Reallocate that capital into something productive, like an index fund or a cash-generating business. Let the remaining portion run. If you invested $10,000 at $40, you bought about 250 ounces. At $100, that's worth nearly $20,000. Sell half, recover most of your original capital, and let the rest continue working. If silver rises further, you still benefit. If it falls, your downside is limited. This strategy isn't exciting, but it's smart. If you don't own silver and you're thinking about buying now because you're afraid of missing out, stop. Fear of missing out is one of the most costly emotions in investing. When public excitement peaks, risk usually increases. The best opportunities tend to appear when assets are ignored, boring, and unloved, not when everyone is talking about them. Over long periods, the S&P 500 has returned roughly 10% per year. That's how real wealth is built, not through prediction, but through discipline. Silver may have a role, but only if you clearly understand why you own it. So here's the bottom line. Silver at $100 could go higher. It could also pull back sharply. No one knows. But decisions based on predictions eventually fail. Decisions based on principles last. Decide why you own silver. Write it down. If that reason still holds, manage the position thoughtfully. If the reason was hype, exit and move on. Wealth isn't created by one trade. It's built through years of consistent, rational choices. Every financial decision you make today moves you closer to the life you want or further away from it. There is no middle ground. Stay disciplined, stay patient, and remember, wisdom, not excitement, is the real edge. I'll see you in the next one. If you want more videos breaking down stories like this, make sure to like and subscribe. Thanks for watching.